$15 billion. That's how much the United States' debt increased in the last 24 hours. This is not theory. It is not prediction. It is not assumption. It is what is already happening right now as you read this sentence. The world's greatest financial power is entering a fiscal collapse in broad daylight, and the whole world is pretending it's nothing. And the most frightening thing, this is exactly how the fall of the Roman Empire began. But here's the blind spot that almost no one is seeing. When the United States bleeds money, the impact reaches every economy on the planet, including yours. The American interest rate is already forcing central banks to raise their own rates. The strong dollar is already putting pressure on the cost of living, and purchasing power is silently evaporating. Most people are still distracted. They underestimate the risk. They don't understand the magnitude of what's happening. But in this video, you'll see a pattern that almost no one is noticing, the same one that preceded other major crises in history. By the end, you'll understand exactly how the United States debt became a tipping point for the global financial system, and what might come next. Now is the time to understand, because whoever understands later will already be too late. The warning that almost no one is paying attention. To every second, the American debt clock ticks like an avalanche. Billions disappear from the federal budget every day, without most of the population even noticing. It seems like a distant, cold number disconnected from real life. But here's what almost no one has understood yet. This number doesn't just represent a deficit. It represents the beginning of the end of a cycle. We're talking about the largest sovereign debt in human history, $38 trillion. And yet, newspapers treat it as if it were just another statistic in the economic news. But there's a detail here that changes everything. This escalation is no longer slow, gradual, or controlled. It's exponential. And when a graph becomes exponential, it's because the reaction time has already passed. For decades, the U.S. economy managed to grow faster than its debt. But now the tables have turned. Debt is growing faster than GDP, and what does that mean? It means the United States is literally drowning in future obligations, just like Rome did before its fall. Empires don't collapse all at once. They bleed until there's no trust left. And that's where everything starts to change. When the market realizes that the empire can no longer afford its own commitments, what happens? Capital begins to flee, silently, without headlines, without panic, but steadily and irreversibly. The same thing is happening now with American debt securities. Institutional investors are already quietly reallocating. Meanwhile, most people remain preoccupied with the trivial headlines of the day. Influencers, celebrities, soccer, memes. But behind the scenes, the world's largest financial system is being redesigned. And when it's fully consolidated, those who were distracted will pay the price. It's always been this way. It always will be. The question is, why is this different from all the other times the U.S. has gone into debt? Because this time, the speed is out of control. In just 1 year, the debt jumped by more than $2 trillion. And there is no viable plan to curb this growth. No real cuts proposed. No structural measures in sight. Just more debt, more printing, more promises. And here's the point that almost nobody realizes. The risk isn't just in the size of the debt. It's in the loss of confidence in the ability to pay. And once confidence is broken, it never returns. Like a house of cards, a small tremor is enough for everything to collapse at once. The crisis doesn't warn you. It simply arrives. That's exactly why central banks around the world are reviewing their reserves. Why do you think government gold purchases hit a record high in 2025? Are they buying because it's cheap? No. They are preparing for a scenario where the dollar will no longer be the center of the game. That seems like an exaggeration now, but wait a few years. And when this process reaches the point of no return, the shock will be global. High inflation, runaway interest rates, and a real loss of purchasing power even in countries that seem stable today. This crisis will not be local. It will be systemic. Because when the center fails, everything around it feels it. And at this very moment, the center is trembling. And the most curious thing, all of this is happening right before our eyes. Without fanfare, without sirens, without red headlines. And that's precisely what makes the moment even more dangerous. The collapse only becomes visible when it's too late to move. But for those who are paying attention now, there's an advantage. Because knowing beforehand is everything. What is the American debt? Most people hear about U.S. debt and imagine something complex, distant, or impossible to understand. But here's the stark truth. It's much simpler than it seems. American public debt exists for a basic reason. The government spends much more than it collects. And to cover that difference, it needs to borrow money. Since the government can't simply pass the hat around, it does it another way. It issues debt securities. These securities are nothing more than promises of payment with interest. Investors buy these securities now in exchange for receiving more in the future. And who are these investors? Funds, banks, foreign governments, ordinary people. That's why you hear people say that China or Japan finances the United States. They buy these bonds. But why would they do that? Because the whole world trusts that the U.S. will pay. And they always have. They've always been seen as a safe haven. And as long as that trust exists, the game goes on. But this is where everything starts to change. With each new deficit, the government needs to issue even more bonds, more paper, more debt, more promises. And since tax revenue doesn't keep pace with the growth in spending, the snowball effect just keeps growing. It's like a credit card with an unlimited limit. It seems to work until the interest starts to pile up, and that's when confidence begins to crack. In 2025 alone, the United States issued over $2 trillion in new bonds. This means the country had to borrow $2 trillion just to balance its budget for the year. No private company could survive with that kind of recurring deficit. But because the US has the dollar, the world still accepts it. The problem is that this still is becoming increasingly fragile because the rampant issuance of bonds generates doubt. Doubt generates distrust. And when trust disappears, the dollar loses strength. And if the dollar loses strength, the whole castle collapses. Because it is this trust that sustains the US's ability to continue borrowing. Imagine this. You have a friend who's always borrowing money but always pays it back on time. You keep lending him money, but if he starts paying you back later and later with excuses, you start to think twice, right? That's what's happening with the US Treasury. The world is starting to hesitate. The detail that almost nobody notices is that the US has a privilege that no other country in the world has. They issue debt in their own currency, which is also the world's currency. This creates a constant artificial demand for American bonds. But if that demand falls, not even the dollar can save them, because the hole is too big. That's why understanding what American debt is so important. It's not just about numbers. It's about a business model that depends on the blind faith of the entire planet. And when that faith starts to crumble, as it already has, the scenario changes completely. What once seemed sustainable now seems insane. And if you think this is still far from affecting you, wait for the next topic. Because the debt may be theirs, but the cost is starting to affect us all. Why did the debt start accelerating so quickly? What's happening now with the United States debt isn't a simple increase. It's a real-time explosion. In just 1 year, the fiscal deficit grew by more than $2 trillion. And here's the point that few see. This jump wasn't caused by an external catastrophe. It was a choice, a model, a sequence of political decisions that ignored the limits of mathematics. Since 2020, American government spending has spiraled completely out of control. First came the emergency pandemic stimulus, then the multi-billion-dollar infrastructure packages, and then social programs more expensive than any previous decade. The problem isn't just the amounts, it's the complete absence of real cuts. This is where things start to get dangerous, because a healthy economy can spend more at specific times, but it needs to balance things out afterward. But the United States did the opposite. They increased spending and maintained this new level as if it were the new normal, as if money were infinite. But it isn't. It never was. To finance this level of ongoing spending, the Treasury needs to issue new bonds every month. But this creates a devastating side effect. Each new issuance increases the pressure on interest rates. And when interest rates rise, the cost of the debt itself skyrockets. It's like paying your credit card bill with another card. It works until it doesn't anymore. Wars also entered the equation. Military support for Ukraine and the Middle East consumed tens of billions. And the United States continues to fund a large part of the global military infrastructure. But unlike past wars, which were funded by tax increases, these are financed purely by debt. Nobody is paying now. But someone will pay later, and those looking from the outside might even think, but that's just American domestic politics. Wrong, because when the US dumps trillions into the global system without backing, it distorts everything. It weakens the dollar, it increases volatility, it fuels global inflation, and it raises financing costs for entire countries, including yours. The reality is that there is no longer any serious conversation about fiscal responsibility in Washington. Democrats and Republicans debate where to spend more, not where to cut. This seems small, but it's not, because it shows that nobody is thinking anymore about reversing the debt trajectory, only about pushing it forward as much as possible. Meanwhile, the American public deficit has become permanent. In 2025, the deficit exceeded 7% of GDP, even without a recession. This is frightening, because if a crisis comes, that number could double. And then the hole will no longer be manageable. It will be an abyss. Few remember this, but until the 1990s, the United States frequently balanced its budget. Now it's as if balance is impossible, as if the current model needs infinite debt to avoid collapse. But no system based on infinite debt survives the reality of high interest rates. And if debt growth continues to outpace economic growth, as is already happening, the crisis ceases to be a future possibility and becomes a certainty on the countdown. And the next factor accelerating this collapse is even more dangerous: interest rates. The most dangerous factor: high interest rates. If there is one element capable of transforming a fiscal problem into total collapse, that element is the interest rate. And at this very moment, interest rates on American debt have reached their highest levels in more than 2 decades. This changes absolutely everything, because now it's not just the debt that's growing, it's the cost of it that's becoming unpayable. In 2026, the United States surpassed the mark of $1 trillion per year in interest payments alone for the first time. This means that before spending a single cent on health, education, or security, the government already begins the year with $1 billion check in hand. A check that buys nothing, it merely keeps the castle standing for another month. And here's the detail that almost nobody notices. Most of the old American debt was issued with low interest rates, but these bonds mature, and when the government needs to refinance, it borrows much higher interest rates. This means that the old debt itself becomes more expensive over time, even if the total volume doesn't increase, but the total volume is also increasing. So you have a double effect, more debt and more interest on every dollar borrowed. This creates a self-feeding monster, a vicious cycle where each new loan is more expensive than the last. And the more expensive it is, the harder it is to get out of this spiral. The US. Treasury is already issuing bonds with rates close to 5% per year. Does that seem like a small amount? Consider a debt stock of $38 trillion. That's almost $2 trillion in annual interest alone over a few years. And here's the critical point. No budget can sustain that for very long. So what does the government do in this scenario? It continues spending. It continues to increase debt. It believes the economy will grow fast enough to compensate. But this is the same mistake other empires made before their fall, believing that external confidence would last forever. But high interest rates erode that confidence like silent acid. The Federal Reserve itself is trapped in a dilemma. If it lowers interest rates, it reignites inflation. If it keeps them high, it bankrupts the Treasury. The dilemma is brutal, choosing between runaway inflation or exploding debt. And the truth is that neither option truly solves the problem. Both only postpone the inevitable. Some analysts still say that the US can withstand high interest rates because its economy is strong. But this ignores the cumulative effect of payments. The longer the time passes, the larger the share of the federal budget that goes just to paying interest. This drains resources from essential areas and pushes the country into a cycle of weak growth and financial dependence. And when creditors realize that a large portion of American taxes is being burned just to keep the system afloat, confidence disappears, because no investor wants to finance a machine that pays interest with new loans. Then comes the capital flight. And when the money starts to leave, the castle begins to tremble. This is the point at which many countries throughout history have collapsed. Rome, Spain, revolutionary France, Weimar Germany. They all went through a stage where the debt was already high. But it was the high interest rates that sealed their fate. And now, this is exactly the stage that the United States is facing. The United States game, why they can get into debt. If any other country in the world did what the United States is doing now, it would have gone bankrupt a long time ago. So the inevitable question arises, why can the US still get so heavily indebted for so long and nobody stops it? The answer lies in a unique geopolitical privilege. They control the currency that the entire world uses. The dollar is not just the currency of the United States, it is the global reserve currency. This means that central banks, sovereign wealth funds, companies, and investors from almost every country on the planet hold part of their reserves in dollars. This creates a constant and virtually automatic demand for American debt. And since the dollar is the currency used in more than 80% of international transactions, countries need dollars to import, export, protect themselves from crises, and even buy oil. And how do they get dollars? One of the most common ways is by buying U.S. debt securities. In other words, the more the world depends on the dollar, the more it finances American debt. Furthermore, the United States has what economists call zero sovereign risk. This means that because they issue debt in their own currency, they never run the risk of involuntary default. They can simply print more dollars to pay what they owe. This is what makes the US different from all other countries in the world. But this game has a hidden price, because printing money to pay debt works until the world starts to doubt the real value of that money. And that's exactly what has begun to happen. Quietly, several countries are already reducing their exposure to the dollar. And this changes the balance of power. Countries like China, Russia, India, and even France have already begun using alternative currencies in some international trade. The BRICS are creating new settlement systems. Central banks are buying gold at record rates. All of this signals the same thing. Confidence in the dollar as a neutral currency is declining. But while this transition is happening, the US is still able to push the debt forward. Because even with all the warnings, there is still no clear alternative to the dollar. The euro is politically unstable. The yuan is too controlled. Cryptocurrencies still lack institutional trust. For now, the game goes on, but the ground is cracking. It's like a castle built on sand. It looks solid, it works for a while. But all it takes is a change in the wind, a geopolitical event, a new payment system, a loss of hegemony, for everything to start crumbling. And what sustains that castle isn't concrete, it's pure trust. What almost no one realizes is that this exorbitant privilege, the ability to take on unlimited debt, also creates a trap. It discourages cutbacks, encourages excess, and creates the illusion that money will never run out. But every privilege misused becomes a vulnerability, And that's why, despite still being able to accumulate debt, the United States is playing for time, because the game only lasts as long as the world agrees to play. And each new flight of the dollar shows that this clock has already started ticking. How this affects your wallet, even outside the US. Many people still repeat the phrase, "That's an American problem," as if the United States fiscal crisis were a distant issue. But here's the brutal truth. You're already paying the price, even without realizing it. The effect of American debt crosses borders and oceans, directly impacting your cost of living, your investments, and even the value of your salary. The first impact is on the dollar. When the United States becomes indebted beyond its limit, the world begins to distrust the stability of the American currency. This generates volatility. And what happens when the dollar rises too much or falls suddenly? The entire global chain feels the jolt, especially emerging countries like Brazil. With an unstable dollar, imports become more expensive, fuel prices rise, and industrial inputs skyrocket. And since many everyday products have imported components, from food to electronics, the impact is directly felt at the supermarket, the gas station, and the energy bill. Inflation is coming even without an internal crisis. And there's more. To contain this imported inflation, central banks need to raise interest rates. And higher interest rates mean more expensive credit, more difficult financing, and slower economic growth. In other words, U.S. debt is indirectly making your car, your house, and your credit card bill more expensive, even if you've never heard of U.S. Treasury bonds. Another point that few people consider is the risk involved in investments. Pension funds, banks, insurance companies, and even your retirement fund may have exposure to assets linked to the dollar or U.S. Treasury bonds. If there's a widespread loss of confidence in these assets, the impact on your net worth can be direct, without prior warning. And that's not all. The American debt crisis is creating a global environment of uncertainty. Investors are becoming more cautious. Long-term projects are being postponed. Large companies are holding back on hiring. The economy is slowing down. And in this silent slowdown, the average worker feels it first. Fewer jobs, less pay raises, less prospects. Furthermore, as the world tries to protect itself from U.S. instability, there's a rush for real assets: gold, land, commodities, real estate. And what does this mean? That survival assets become increasingly expensive and inaccessible to those who do not position themselves early. The result is increased inequality on a global scale. The cycle is self-reinforcing. The more the U.S. becomes indebted, the more unstable the system becomes. The more unstable it is, the more central banks react with harsh measures. And who suffers most from high interest rates, inflation, and loss of purchasing power? The global middle class, those who have little to lose and much to be impacted by. Meanwhile, the big players, funds, banks, governments, are getting ahead of the curve, reducing exposure to the dollar, buying metals, diversifying reserves. And you? If you're still waiting for the crisis to hit before you act, you're already years behind. Because the American crisis isn't going to make headlines in a spectacular way. It's already begun, and your wallet is one of the first to feel it. The only question now is, will you protect yourself or remain exposed? Will this end badly? The two possible scenarios. We've arrived at the question on everyone's mind. Will this end in collapse, or is there still a way out for the United States? The short answer is, it depends. It depends on the choices made in the coming months. And even then, there are only two possible paths. One scenario of tight control, and another of complete breakdown. Let's start with the best case scenario, control. In this scenario, U.S. economic growth accelerates consistently, above inflation. Tax revenue increases, spending is gradually contained, and the debt begins to appear smaller relative to GDP. It's like losing weight, not by losing pounds, but by growing in size. It's possible, but it requires discipline. The problem? This has never happened without real budget cuts and tough reforms. And none of those measures are on the table now. On the contrary. Both parties keep promising more spending, more subsidies, more programs. Nobody wants to be the politician who applies the brakes. And meanwhile, time is running out. Each day with high interest rates increases the bill. Even in a controlled scenario, there would still be moderate inflation for years. Purchasing power would continue to fall, but in slow motion. There would be erosion, but no rupture. The debt would be diluted over time, at the expense of the population. It would be a silent way of transferring wealth. Those who have assets preserve them. Those who have wages lose them. Now, the second scenario. And here the story gets darker. If the market loses confidence in American debt, whether due to a political crisis, a technical default, or a new war, the global financial system goes into shock. U.S. Treasury bonds are the cornerstone of global liquidity. If they fall, everything trembles. In this case, the dollar rapidly loses strength. Inflation in the U.S. skyrockets. The Fed tries to react by printing even more money, and the world begins to abandon American assets. The result would be a crisis of confidence, similar to what happened in Weimar Germany or in 3rd century Rome, a spiral of collapse. Would this be the end of the dollar as the monetary standard? Not instantly, but yes, this scenario puts its status as a global reserve currency at risk. And without this status, the U.S. loses its superpower, the ability to issue debt on a global scale. Fiscal dominance becomes a trap, and the only way out becomes to cut drastically or print until the end. The most unsettling detail? Signs of waning confidence are already appearing. Foreign purchases of U.S. Treasury bonds have fallen over the past 2 years. Central banks are buying more gold. China is diversifying bilateral agreements away from the dollar. Scenario 2 is not fiction. It is unfolding now. So we return to the initial question. Will it end badly? If nothing changes, yes. The crisis scenario is no longer a remote possibility. It's a predictable path. The only way to avoid it would be a shock of fiscal responsibility, which no current government seems willing to face. And here's the key. Whoever understands this sooner will be better positioned. Because when the tipping point arrives, there will be no more time to react. What you decide now defines which side of history you'll be on when the cycle closes. What you need to pay attention to from now on. If you've made it this far, you already understand. The U.S. debt crisis is not a theory. It's an ongoing process. The question now is no longer if something will happen, but rather when and how. And to avoid being caught off guard, you need to start observing the right signs, the right data, the right decisions, in real time. The first critical point is American interest rates. Whenever the Federal Reserve raises or maintains high rates, the cost of debt explodes. Keeping track of these decisions is no longer just for economists. It's financial survival. Because every interest rate increase there affects credit, inflation, and assets here, the world revolves around that rate. The second point, the rate of debt growth relative to GDP. If the American economy grows by 2%, but the debt rises by 6%, this is a sign of accelerated deterioration. Follow the quarterly reports. Look at the ratio between revenue and spending. If the curve continues to widen, the end is approaching. Another crucial indicator is the buying and selling of U.S. Treasury bonds by foreign central banks. When countries start selling these securities, it's because they've lost confidence. The outflow of international capital doesn't generate immediate panic, but it triggers silent ripples that affect everything, from exchange rates to stock markets. Also observe the decisions of the American Congress. If the paralysis between Democrats and Republicans continues, without real budget cuts, the alert is red. The political impasse aggravates the fiscal problem. Fiscal dominance only grows. And any additional noise, a war, a default, a recession, becomes a crisis trigger. Pay close attention to the international reserves of emerging countries. The more gold and alternative currencies central banks accumulate, the clearer the trend becomes. The world is trying to protect itself from the dollar. And this is not normal. This is a direct reflection of fears about the sustainability of U.S. debt. Furthermore, start observing the prices of real assets. If metals like gold and silver continue to soar, it's not just speculation. It's a flight from paper money. It's a barometer of distrust in the financial system. When gold rises while the stock market is booming, something big is being hidden from most people's eyes. Another silent signal is the increase in derivatives that protect against American default, such as CDS, credit default swaps. When these insurances become too expensive, it's because professional investors are preparing for a disruption event, and they always prepare before the general public realizes the risk. Finally, observe the behavior of the giants: BlackRock, Vanguard, JP Morgan, Berkshire Hathaway. They never give any warning, but they show everything in their portfolio movements. When they reduce exposure to treasuries, increase cash, or rotate positions into alternative markets, it's because the game is changing. These are the warning signs of a crisis that won't be televised until it's too late. Those who are distracted will be surprised. But those who understand what to look for and position themselves in advance will navigate the chaos on the right side of history. And now that you know the signs, the question is, what are you going to do about it? Throughout history, all empires that ignored the warnings of debt ended up the same way, collapsing. Rome, Spain, France, Germany, Venezuela, each in its own time, each with its own versions of stimulus, indebtedness, and overconfidence, until the breaking point. And now the United States is following the same script, step by step. The difference is that this time, you're seeing history unfold in real time, with access to data, patterns, decisions, and consequences. The question remains, does this change the way you think or the way you act? Because understanding is only the first step. Most will understand too late, when the dollar no longer has the same value, when interest rates are suffocating, when prices rise and no one knows why, when the system is already in emergency mode, and there is no more time to move calmly. Do you prefer to watch everything from afar or to position yourself intelligently now? What will you do with this advantage of being among the few who truly saw the pattern before it was complete? The crisis may seem distant, but it's already impacting your cost of living, your investments, and your financial future. And those who prepare first pay less and profit more. That's the rule of the game in any economic cycle transition. So if this content helped you see things more clearly, subscribe to the channel, activate the bell, and like this video. That way, you'll stay ahead in the next chapters of this story, because yes, it's only just beginning, In the next video, I'm going to show you exactly how major investors are positioning themselves outside the dollar and where the money is really going. It's the kind of information that turns observers into protagonists.